Hello, everyone. My name is Tim Cohen. I'm the editor of Business Maverick. Thank you for joining us for this webinar. I think it's going to be a lot of fun. We are talking today about the interaction between fund managers and corporate executives. They can't really be. I mean, there are more important things, but very few, I think. The South African executives of listed companies are managers of something like 2 or 3 times South Africa's GDP. They have an enormously responsible job. Our interaction with them takes place principally through fund managers. There is, of course, some direct contact, of course, but mainly it happens through fund managers, and fund managers interact with corporate executives through letters, meetings, questions, and of course, most importantly, through voting the shares if we as shareholders give them the proxy, which mostly we do. So this is a very interesting interaction. It's a very important one. But it's also a very private one. It's private, I think, because both managers and fund managers. It's confusing. You have to keep the two separate. So fund managers and let's call them executives rather. The interactions between the two really guide how companies operate. They're an indication to management of companies what the companies should be doing, and maybe where they're falling short, where they're succeeding. They're an enormously important conversations. So to lift a little corner on these private conversations, the international analytics firm and investment advisory firm RisCura has now twice done a questionnaire of fund managers about these meetings, trying to get a feel for, generally speaking, what they're like, what happens there. I'm delighted that Malcolm Fair, who's the managing director of RisCura, is on board today to tell us a little bit about what the survey found, just as a sort of as a check on whether Malcolm's report is accurate or not. We have an actual fund manager with us. This is Zwelakhe Mnguni, the Chief Investment Officer of Benguela Global Fund Managers. He's well known in the industry. He's very respected, as is Malcolm, of course. Welcome to you both. Thank you for joining us.
Thanks very much, Tim.
Thank you.
Malcolm, you talk about the process of both interacting with management and also the voting process collectively as stewardship. Why is stewardship important? Maybe we should start there.
So Tim, if you look at a dictionary definition of stewardship, you'll come to some version of supervising or taking care of something. And I think that the sort of positive connotation in that is really at the heart of what stewardship is about. And ultimately, really, in the context of the investment world, we're talking about the process whereby fund managers, or the proxies of asset owners, let's call it, are engaging with corporates to lower risk, increase return, and ultimately to also improve sustainability of companies. And it's that process. It's the key channel for communication, actually, between shareholders as principal stakeholders or as key stakeholders for corporates and the corporates themselves. And so, it's a piece of terminology also which has been taken up globally, slightly less commonly used in South Africa, and we tend to refer to it as proxy voting and engagement locally. but more increasingly now, first world countries are releasing what they call stewardship codes, which are sort of codes for how to do this well. And so, we're helping to introduce that terminology into South Africa.
Why shouldn't we? I mean, we own these companies. We're not only we're the great mass of shareholders out there. Surely we should be the ones who are getting feted in the room with the management, and we should be told exactly what happens there. No?
Yeah, I mean, we should, and as the asset owners, you're the one who owns the philosophy around how you want your assets to be invested, and technically speaking, your stewardship provider or your asset manager who's doing that on your behalf is contracted by you to perform those services. And actually, one of the findings of the report was that asset owners should be clearer about communicating what their philosophy and preferred take is on how stewardship activities should be implemented by the asset manager on their behalf.
So tell us a bit about the survey itself. How many people did you survey? Who did you survey? What did you ask? What did you find? How does it compare to your previous survey? If you can just answer that in one sentence.
Okay, I'll try in one sentence, but it'll be a long one. No, so we ran a survey similar to this in 2011. We called it Spoiled Votes, and it was interesting in its findings, and maybe we can reflect on the differences later. But it's 10 years on. When we launched it back in 2011, it was along with a code in South Africa called the Code for Responsible Investing South Africa. And that code was due to be relaunched this year. It's been kicked into 2022, but in collaboration with the board of CRISA, we said we'd repeat the research. And so we, this time around, did an online survey. We surveyed over 80 asset managers in South Africa. So these are South African managers managing South African assets, mostly shares on the stock exchange. But many of these asset managers also manage bonds and other asset classes as well. But the focus really here was on shares or equities. We got responses from 52, and RisCura is in quite a unique position within the market. Is a lot of our clients are South Africa's largest asset owners, so the very big pension funds, the big medical schemes, etc. And as a result of that, we have to have very good relationships with all the managers, because they're the ones executing investments on behalf of the institutions. And we're advising our clients on the various strengths and weaknesses of asset managers. So we have very good relationships with them, and the asset managers also want to sell themselves to institutions via us to some extent. And so they're very happy to chat to us about these issues. So it's an unusual circumstance. It would be difficult to get everyone in the room under normal circumstances. And as a result, we were able to get 3.9 trillion rand of private asset manager money in the room. We made sure we got every large asset manager in South Africa, all the big names that you hear of. And about a few managers didn't respond to the online survey, but we then went back and had in-person interviews with the chief investment officers of the largest. We ended up with 17 managers. It was the length we had time for. But once again, because of our position in the market and our relationship with the institutions, we were able to actually get the chief investment officers in the room, which for a survey like this is unusual, because some of the time the actual practices of stewardship are executed by analysts or proxy voting specialists in the business, and the CIO may sign it off, but often doesn't see what goes on. So for us to actually get the CIOs in the room and talk to them about what they're doing was an important part of the process, and it was fascinating, absolutely fascinating.
Well, we'll get to the what the report finds, but Zwelakhe, maybe I can just ask you in broad terms. You've seen the report. You were one of the people who were surveyed. Do the findings of the report match your experience? What's in what way do they not match what's your experience of interacting with corporate execs?
Thanks very much, Tim. Yeah, I mean, the report is excellent in every way. I mean, it covered all the issues, even those that I thought were secrets about the challenges of engagement, and it's actually quite a good report, and I certainly think, or at least hope, that it will get a lot more broader coverage in the market. There are a number of issues that it highlighted, and some of the issues that frustrated us at Benguela were what they highlighted: systemic issues in the whole ecosystem, issues of judiciary, issues of the regulator. A lot of times, for one to move the needle, you also need the regulator to be part of the process, and I think in our experience the regulator is missing in this instance, and it's been quite a frustration. So the report is really spot on.
Okay, well, you don't have to gush. Just you can. we can together. We must put Malcolm on the spot a little bit later, just to so that we're fair. Can I just say to all of the guests listening? Sorry, go
Tim,
ahead.
on that, I think he could have done a lot more to put the regulator under pressure, or at least put on the spot. But
okay.
From the fund management side,
at least he was raising the issues that. Yeah, it must be reassuring to know that the issues that you are having, you know, are issues that other people in the industry are having too.
Yeah.
Can I just say to people listening? Obviously, we're going to take questions at the end. We'll try and leave as much time as we can. And you will also get the report, or you'll have access to the report. We've also written about it already on Daily Maverick. So please do have a look at our story. I'll get the URL to the story that we've written about it. I'm sure you'll be interested after you've heard us talk about it. Okay, let's get into it. Malcolm, so are stewardship practices improving, and if so, how?
Yeah, so I think the short answer is yes, they are. It's an interesting one, though. If you spell out the two kind of key practices of engagement and proxy voting, on the engagement side, I think the biggest thing there is that actually since 2011, when we did this, the engagements with corporates on matters are much on a broader swathe of matters are much more integrated with the sort of straight up engagements around, frankly, the bottom line. So when we did this in 2011,
okay,
you know, it was a much more sort of profitability, capitalist focus from the industry. Whereas now there's a much broader scope of issues that have been brought to the table, and managers are much more understanding of all of those issues. We'll come to the relative understandings of the different kinds of issues later. But and then on the proxy voting side, interestingly, there in 2011, we found that the plumbing of the system. So when you vote a proxy, the corporate issues the proxies a couple of weeks before the AGM, and then the managers need to basically come up with the responses, and then it goes through a whole lot of plumbing works before it actually gets back to the AGM and the votes are counted on the day. And we found the plumbing to be quite actually broken in 2011.
Okay,
and it was pleasing to find that seemed to have improved quite a lot. So those, on the whole, there was improvement.
Okay, good.
The worrying thing for us, and this is in the report as well, the worrying thing is by objective measures, we pasted in the report a World Economic Forum study, which is a perception study of what people think of shareholder governance in South Africa. And alongside some of the other issues, financial related issues that those filling out the survey had to respond to, we've fallen off a cliff over the last 3-4 years.
Yep.
And that's really worrying. We were ranked number 5 in the world on shareholder governance. And, we're right down now at number 30. And that's been the last 3 years. And that is a finding that was really worrying.
Yeah. Zwelakhe, maybe you can give us a bit of a feel for these meetings. I'm sure you've been involved in them. I presume that what you do is you sit across the table and you shout at each other, and they try to pretend that they're doing what you say they should be doing, and actually they're doing exactly what they feel like. And you notice that they're not doing that, and then you throw the stapler or whatever's on the water. Either that's my one perception, or my other perception is as you walk in, everybody's like, Zwelakhe, my friend, come this way. Can I give you a glass of champagne? Please sit here on this waterbed while we explain to you why we made a loss. What are they like?
Yeah, thanks, Tim. Certainly the engagements are a lot harder than what you described, but certainly not throwing a stapler yet. And
have you ever thrown a stapler? You've never thrown a stapler.
I think if I look at over the last 10 years, probably the safest approach has been to first engage, write a letter, and then get a meeting. So oftentimes that approach kind of ventilated the issues before the actual meeting, and if one side has got some maybe anger issues, they can deal with them before the actual meeting. So that is the first thing. And then by the time we meet, there is a sense of professionalism that comes through. But certainly the issues are raised, and there is tension. You can feel the tension. And I think the executives sometimes have found a way of basically pretending to be listening sometimes. And there are instances where you walk away and you feel that they're serious about what they want to do, that they've taken your concerns on board. But there are also situations where you, especially if it affects them, they tend to be a lot more hostile. And I can tell you about strategies that we even use at Benguela that don't fight the whole group, take one person, isolate that person, try and challenge that one. Because if you fight them as a group, they tend to basically club together and they'll defeat you. So either CEO or chairman. And the meetings are often, sometimes you get this anger from, if it's a Questbacker, he'd be angry if we're raising issues. But there are also other executives like the Woolworths team. They're very friendly, very engaging, listening, and so the experience is varied. But certainly, what has worked for us is communicating the issues in advance and then having a meeting. I think that has worked out quite well.
Oh, that's interesting. I mean, if you wanted to find an excuse for them, you could say they are A personality types often. So these are very assured people, and secondly, they are talking about their businesses, which is really close to their hearts. They extremely involved, engaged. They live these businesses day and night. So
and their remuneration.
Yes, and they pay themselves for that. but I do. It's Malcolm was talking about how the parameters of the conversation have changed quite a lot. That there was in the past really a kind of focus on the numbers, more or less, to the exclusion of everything else, and that conversation has widened now. To a whole bunch of issues, including governance. Is that your experience?
It is indeed. when I started in the industry, I mean, the whole focus was only on numbers, and there was nothing else that really one cared about. And even in the proxy voting, if the issue didn't affect the numbers, I don't think it was given much attention, and that has certainly improved. That has certainly improved to a point where the issues are now broad. There are social issues, there are environmental issues that have been dealt with, there are governance issues, and I think in the last, say, 10 years, as Malcolm said, the focus has been a lot more on governance, and the other two issues haven't been given much attention. But I think there has been a big improvement in the right direction.
That's an interesting point, Malcolm. The survey did touch on these things. Maybe you can talk about ESG, this is environment, social issues, and governance. You had a very cute part in the report I saw, which said that in ESG, the G is a big G. The E, environment, is a small e, and the S is non-existent.
We ended up putting an underscore just to say, there should be something here. It was really interesting. Look, firstly, just quick introduction for the listeners is, it's become it's certainly globally very commonplace and rapidly in South Africa as well, to engage with corporates on these three sort of bucketed issues: environmental issues, social issues, and governance issues. But the one of the findings of the report actually was that managers have, because historically engagement was a lot around governance and that was linked to the numbers, that they've struggled to make the conversion to social and environmental issues easily. To the extent that what we were fascinated about on a couple of occasions was that an example, for example, Zwelakhe mentioned incentivization earlier, is, a manager would talk to us very passionately about how they're engaging with the corporate management about their incentivization structures and how they're bringing changes to that, and how they plan to realign them, etc. And when we said to them, well, presumably these engagements, were seen by them as being governance engagements. Right. Okay. When we then raised, but obviously remuneration must bring in issues like, for example, the executive wage gap, which, as we know, is dramatic in South Africa, or for example, the gender wage gap, which, as we know, is a big social issue globally. We often got blank stares. It was like, well, no, that didn't come into our thinking. And it just seemed like such an obvious, no-brainer. Is here you are engaging on the so-called governance issue when actually wages is a major social issue, which you could quite easily reframe this very same engagement into being a social issue. And yet, the managers just weren't there. So, that was an interesting one that we found. And so we ended up concluding, G is the big one. S is smaller. E is quite prominent in our country because, ESCOM is very topical, and, we've just had COP26, and the research was done in the lead up to COP26. And, ESCOM is a big polluter, and then obviously Sasol is a very big share on the Johannesburg Stock Exchange. And so, many managers brought that up as an example where, they were looking at engaging on matters of environmental nature. So that is getting more airtime.
Does the survey show, or just do you know from your experience? Is it the fund managers who are driving this? So it's coming more out of fund managers than it's coming out of the executives off their own bat.
Zwelakhe can maybe also talk to this from his experience.
Please do. Yeah,
I would say a lot of these issues, I think the difficulty comes back to incentivization, and one of the issues we also raised in the report was the short-termism versus the long-term nature. So, in this chain, and we make this point very clearly in the report about fiduciary duty, is that actually the fiduciary duty of the asset owner is to their beneficiaries, and the asset manager is effectively contracted by the asset owner, so the board of trustees, as needing to convey their message. So the message should actually be coming very strongly from the asset owner, and the asset managers are then the mouthpiece of the asset owner to express this. And asset owners should be thinking very deeply about, all of these issues and how it affects their beneficiaries, members, etc. On the flip side, the corporate, the board of directors has its own fiduciary duty to its stakeholders, the shareholders being one of them, but obviously other stakeholders as well. And actually, the managers are in between these two sets of fiduciary duties that actually, frankly, in some cases, aren't wanting the same things. So it's quite a hard balance for the managers. But in general, the managers, I would say, are engaging on a wider spread of issues, and they're bringing things to the table because on behalf of asset owners, they know that they need to take a longer term view. Many of the asset owners in our country are pension funds. Pensioners will retire in current pension funds in 2080. What does South Africa look like in 2080? How will that environment actually look? And how corporates perform between now and 80, or what they do to environment or society, is actually very important to, the outcome. As much as the money is important, is the outcome for these members is, what is that world going to look like? So it's a very interesting sort of role that the asset managers need to play between these two duties, and they've got to they essentially are executing on behalf of the asset owners. So the messaging should come through that way.
Zwelakhe, maybe do you want to come in on this too? Because do you kind of when you sort of say to managers, can we please see your social policy, do they look at you kind of blank, or do they say, oh, here it is, here's my 45-page sustainability report?
Yeah, Tim, I think it's quite interesting what if you look at this, I almost look at it as like the pressure groups because the fiduciary enforcement lacks a legal backing. So you can go to a company and say, I want a social report. They say, we are not required to disclose it. In fact, there's a company that recently told us that we are not required to disclose our environmental issues. And then we proved to them that their numbers were wrong, in fact, from a long list of calculations. So that missing fiduciary enforcement mechanism for the fiduciary duty does create a gap. That's the first thing. The second thing is, I think the reason that the engagement has actually been coming from the asset owners, the pressure has been increasingly more from the asset owners, because all along the fund managers were left to their own devices to basically engage as they deem fit. But what has happened is the asset owners have asked for accountability, and RisCura being one of those asset consultants that basically engage, and they want to know, what are you doing for the underlying owners of the assets? So that pressure has been building, and has led to fund managers to kind of try and engage a lot more actively on the corporates. But there is one area where there is a bit of weakness, where you look at the corporates. If you look at, for example, the role that is played by remuneration in terms of guiding the rest of the issues. When you look at the scorecards that are used, a lot of times it's earnings growth focused, and very little is said about returns, about social issues, about safety. They are not included in those scorecards. So, and I think it is one area where the corporates may need to up their game in terms of including these things. But the challenge is that they don't include them because there is no pressure. And we've spoken to the JSE about some of the issues. There is no pressure that says these things, you must cover a whole range of issues around being a good corporate citizen. It doesn't. And what the board tend to do is to focus on earnings growth and very little incrementally of late. We've seen the returns coming to the fore. But then there are a whole lot of numbers that don't make sense, where a CEO, they could measure them using return on equity, and the CEO can go and gear up the company to basically increase the return on equity. They've done nothing. They haven't improved the productivity of the business. So the pressure has definitely been coming from the asset owners to say, what are you doing? And when we go down as fund managers to the executives, the challenge is that there isn't any legal enforcement. And Malcolm wrote a lot about that. I think it's quite a valid gap in the ecosystem.
Yes, there isn't a powerful enough incentive system. I think that's what's missing here. Is that I presume that it differs widely by sector. And in my experience, the South African executives they are very different. As you would expect. You know what I mean? So I find the banking execs, they're very aware of these issues, and they talk about them all the time. The insurance companies, it's the same thing. The companies are forced to do it because their mining licenses depend on it now. So there's a very powerful incentive system in the mining sector. Just tell me if I'm wrong. But I do think a lot of the other sectors, like retail, just to take one example, they sort of think they're doing their social job. Well, they are doing their social job in many ways, just by hiring people. You know what I mean? I mean, they think their social responsibilities begin and end with the employment contract. I'm generalizing a bit. Maybe I'm completely wrong. Tell me if you think I'm wrong. I mean, but the point that I wanted to make is that there are big sectoral differences.
There are indeed. So you spotted on the mining sector, because the licensing is attached to some conditions. They tend to be a lot more proactive. But certainly the retail sector, one of the things that they tend to highlight is the diversity of their staff members. But if you look at the top, there is no diversity. So no gender diversity, generally no racial diversity, and even at a skills level, there's no diversity. There's one board that we engaged with them, and they were like, they had the audacity to have people below them that were actually not understanding the customers where their stores are. So there was no understanding, and it didn't bother them. It was only when we engaged with them that they said they realized that there is maybe a need to transform that area. But those are some of the things that at sectors like, for example, the energy, I mean, that sector, they're very much aware about the environmental issues. They're very much aware, but they also use the social issues to try and delay the change. For example, they would often say, if we transition the business too quickly for carbon emission reductions, basically people are going to lose jobs. And that is a defensive kind of angle that they use to basically get the easy outcomes, because if they can continue polluting without being held accountable on the basis that they are creating jobs, that is an easier pass, because they don't have to innovate, they don't have to do it. So those are some of the challenges.
Yeah.
Go for it, Malcolm. A slightly different version of sector, but a very interesting thing about the Johannesburg Stock Exchange is that whilst there are many South African stocks issued in issue on the stock exchange, actually many of those companies earn their earnings outside of South Africa. So if you look at total earnings on the Johannesburg Stock Exchange,
right,
60% of the earnings are earned outside of South Africa. And in fact, through history, a number of stocks that were originally South African, take Naspers, for example, now has very little to do with South Africa at all. And in fact, the earnings mostly come from offshore. And, you know, as I love to say, through a difficult 10 years of economic growth for South Africa, South African savers were basically saved by 1 billion Chinese people using the internet and bidding up the stock price of Tencent, which Naspers owned. You know, so these companies actually have little to do with South Africa, and interestingly, the engagement with those companies, because they're global, from say the European investors into those companies, is at a different level and perhaps coming from different angles. So they're more prepared. The South African stocks, those that are, you know, more South African orientated and have most of their earnings here, you know, the pressure hasn't been on them from those global investors yet as much. And so, you know, there's a difference between those two sectors, actually, interestingly, on the JSE.
Okay. All right. I can just remind our listeners, if you want to ask a question, please do type it into the box on the right-hand side, and I'll ask it. I'm sure there's lots to ask about it that we're not covering. So, like, I just wanted to ask you about how the engagement process affects your investment decisions. Are you? I mean, obviously they do, right? This is part of the point of the whole thing. But would you say you're more inclined? You know, your first priority is to look at the numbers. Your second priority is to talk to get a feel of the management, or do you really make your investment decisions largely based on your interactions with management?
Yeah, Tim, I think we take a two-stage approach. The first thing is we analyze the numbers and we formulate a view, basically, of what is happening in the business. And then when we engage management, what we are trying to do is to get confirmation of whether what we are seeing is aligned to what they are saying or something else. And we would often submit to them the questions in advance and give them the calculations on which our assertions are based. And there are also situations where just the numbers are enough for us, and oftentimes that when we haven't even invested. So we would just go for a fight right away because the issues are so obvious that if you even go and engage them, they tell you a story about the financial numbers and the other issues that are in place. And a very good example is this company that I was talking about, Super Group, where the numbers, the environmental numbers, were so wrong that we didn't even waste time to meet with management first. We actually went and said, these are the numbers that you reported, they are wrong, and this is the evidence that we've got. And they basically undertook to change the disclosure. But that kind of situation, it depends what you are trying to achieve. Sometimes, like, the numbers are so misleading, everybody else, and that's what we wrote to them. We said, everybody in the industry is relying on your numbers, and the numbers are wrong. So you're basically misleading the whole industry. So that kind of thing, the numbers would drive the agenda. But there is also where you have to marry the financial analysis with the engagement, that the strategies make sense relative to what we are seeing in the numbers.
Right. Oh, that's interesting. I mean, Malcolm, on that question, you did have an interesting part of the report that was about evolution engagement. I mean, in the past, your report says there was an inclination to rather just disinvest. If you saw something that you didn't like, you just disinvested. Now there seems to be more of an appetite to see whether you can change it. Is that sounds very hopeful Is that correct, or is that just what we would wish to see?
Yeah, no, I mean, so escalation is very interesting. Maybe before I get into that, I just want to explain one piece which is important about the engagement process, and therefore how and why you would escalate. As a matter of course, a shareholder's first sort of starting point with a corporate is generally what corporates call their stakeholder engagement person. So they have a team, and it's mostly the stakeholders are shareholders, and so that person is hired by the corporate and incentivized by the corporate to keep stakeholders happy.
Right.
And then it escalates to, well, actually, we want to talk to the financial director, and please can we also talk to the CEO? So there's some escalation there already. The point about the fiduciary duty that I find so fascinating, and we've written about as key in our report, is that actually the fiduciary duty to the company sits with the board of directors, and that any management, so the CEO, the CFO, the person communicating shareholder engaged to the shareholders, those individuals are actually contracted by the corporate. They don't have they may, because the CEO has got two hats, but the contract with the corporate and the incentives that they have that the corporate puts in place actually muddy the water dramatically in terms of what the actual fiduciary duty is. And so the escalation process has to start with management, but actually it often starts with management, but actually the right place should be the chairperson. I mean,
yes.
In fiduciary duty means that no matter how big you are, if you have an issue that is material to the long-term, sustainability of this business, then the fiduciary duty of the board of directors must be to discuss and engage around that issue until you've satisfied yourself that either it's not that a material issue for you, or that actually you need to do something about it, and here's the outcome. But management, on the other hand, mostly because of their contractual relationship with the company, they're actually just incentivized to, sadly, in a lot of remuneration policies, and this is where a lot of engagement happens, is to maximize profits, and perhaps even in the short term. And so, what we get is this mixed messaging. So actually, one of our suggestions in the report is that managers need to understand this fiduciary duty much more clearly, so that they go to the fiduciaries and they engage with them.
Yes.
As a first step.
I get it. That's interesting. All right. Well, let's since we started on remuneration, let's go there. It's a completely non-controversial topic. Zwelakhe, talk to us about executive pay. I mean, South African executives get paid too little, right? I mean, they are basically starving. They are really struggling to buy the 25th Mercedes-Benz, and we need to intervene here to help them to make life better. Am I characterizing this correctly?
No, I mean, I think relative to the living standards in South Africa, they are not paid a little. I mean, certainly relative to their global peers, and I think that the world has gotten into this race of remuneration where, because the skills are becoming more and more scarce, and you need more and more incentives to basically attract these highly skilled executives. I think we are seeing the boards, and certainly in a number of our engagements, when we raise the issue of the pay gap or the unfair method of incentivization, they often refer us to say, look at the global peers, they're getting paid X amount and our guys are getting paid less. So I don't think they're getting paid little relative to South African standards, but they definitely, relative to global peers, there has been a trend where there has been an upward pressure on remuneration. I mean, it doesn't help that people like Elon Musk took no pay, but they got a big payday. So those are the kind of things that executives tend to look at and look as a reference. And another point that I'd like to add is when you look during the difficult years in a business, so the cycle is out of favor, the executives tend to be a lot more disciplined, focused on all the issues, social, environmental, those things. They try and trumpet those things a lot more. But towards the end of the cycle, as we saw in this resources run, what tends to happen is they push a lot harder to try and get more incentives, and there is that fluidity in the process, and it is a function of weak boards. It's a function of chairmen that are basically seeing their responsibility as looking after these executives. And a very good example was in the COVID crisis. Many of them, their incentives were reset. And you'd remember years ago when Dimension Data and Data Tech had those look-back options, and there was a big outcry in the market. This time, there were a few fund managers that were complaining, but they still pushed them through.
All right. Yeah, I mean, it seems, from the public's point of view, there's what really enrages the public is when a company's profits decline and the exec pay goes up. I think people just get furious when they see that, and it's a big stick in the works because they blame everyone. You know what I mean? They blame government, they blame fund managers, they blame the press, for not making a big enough issue out of it. I mean, I think the fact is that and people always, there's a kind of natural bias in the whole process because people compare it to what they're earning, and they just can't believe it. They can't believe that people get paid $30 million a year. That's, Malcolm, what does the survey show about executive remuneration? Are fund managers more active on the issue, less active? Is it a kind of embarrassing thing people don't ask about?
No, actually, interestingly, this was an area that was very well researched and engaged by all managers. In fact, at one point, I found myself thinking, if only there was more collaboration between managers, and that's another finding of our report, that there should be, or suggestion of our report, there should be more collaboration between managers, because you can imagine the remuneration committee at a corporation getting engagements from 30 different asset managers about how the remuneration package should be structured. And there's a lot of competing needs, and they've got to make sense of that. And by the way, another finding there was that corporate management play off the various asset managers because they're not collaborating. So, for example, first manager comes in and says, we think you should do this because it's material to the business. And corporate management says, it's funny that you should say that. No one else has said that. And so we're not sure it's that important. And then the next manager comes in and says exactly the same thing. But they repeat the same message, which is, no one else has said that message to us. So, we're not sure it's that important. So actually, on issues like remuneration, we think there should be more collaboration. And incentives need to be very, very carefully thought through because of what I spoke about earlier, is the muddying of the water between the contractual relationship that management have with the corporate and the fiduciary duty that the actual board of trustees has. They're, even improving that governance is, who's the head of the remuneration committee? Those are the kinds of things which now have come to the fore. A lot of asset managers are engaging on. And this is a very emotive issue when you take it to management. Now, if your first stop is management, obviously they're going to hotly contest it because it affects, their personal bottom line. But when you go to the head of the remuneration committee, who's usually an independent, in theory, they should have a more objective view of what should be done.
Yeah. So, I think that the fascinating thing, this is slightly off topic, but I do think the most fascinating thing about corporate remuneration is that we all expected that the publicity of corporate remuneration would make a difference, that it would create a downward pressure on corporate remuneration. But it seems to have had exactly the opposite effect. So, if one bank knows that the CEO of another bank is earning more than he or she is, right, then they sort of wonder what's wrong with me, You know what I mean? And the board thinks, oh my God, if he's getting paid less or she's getting paid less, he's going to go there. You know, it's sort of it's had the effect of cycling up corporate remuneration. I mean, the extent of it is just extraordinary. I mean, we don't have. I think we've got some good figures on it in South Africa, but I did look up just in preparation for this. There's something called the Economic Policy Institute that says CEO compensation has grown 1,322% since 1978, and typical worker compensation has risen by 18%. I mean, you know, CEOs in South Africa earning income a year. It's true in the US they're making $24 million a year. That's the average of the top. I mean, you know, I do think. So go ahead, Melvin.
There's an interesting point in here, which is, you know, it's a little bit self-fulfilling, but there's also an arms race playing out. So, you know, yes. Public pressure needs to be now countered by factual information. So, you know, let me go and find out what other people are getting paid at my level, and then the excuse often also is, you know, we'll lose this very important CEO to our business if we don't pay them what they're getting paid. Couple that with the issue that, as I explained earlier, many corporates have gone offshore. So now, and that gives them the ability to suddenly say, look, actually,
yes.
compared in rand,
you must compare me
to the $24 million that person's getting paid internationally. Yeah. You know, which is, you know, so it's a fraud issue, and it's an arms race. Just you know,
okay, let's move on to questions before we run out of time. This one's for Zwelakhe. It comes from Gebuza Langa. He says, in his opening remarks, Zwelakhe mentioned in passing that the regulator and the judiciary do not cooperate as much as desired. I'm interested to know in what way and to what extent the judiciary does not cooperate.
Yeah, thanks. I think if I make a classic example, I laid the criminal charges against Marcus Jooste for fraud.
Right.
The process is stuck. I've been to Silverton, I don't know how many times, where the investigator shows me that they've got some evidence that they can prosecute him on. But somewhere in the system, the things are not moving. So from a judiciary point of view, there isn't any agency to prosecute. I mean, the damage that was done by Steinhoff is so significant. We should have seen by now some outcome from the judiciary. It should have been something that had been focused upon, but that is not happening, and it doesn't look like there is a determined from that guys can be scared that if I do something wrong, there will be punishment. I think that is where the weakness is, and I think the report highlights that too. That guys like EOH, guys like Tongat, many of those guys, I mean, nothing has happened. African Bank, nothing has happened. So there is no enforcement, there's no follow-up.
Yep, I mean everybody in South Africa feels the same way, I think.
Yeah, you know, we're not legal experts by any stretch of the imagination, but it was a very interesting part of our findings, and so we did some cursory research into this, mostly to see, you know, is there something that actually the financial industry could do to improve the situation. What was interesting about the findings is that it turns out that, you know, if you want to prosecute a white-collar criminal, because it's a criminal investigation, it has to be prosecuted by the National Prosecuting Agency. I mean, we all know, because, you know, law is a subject matter of the newspapers daily, and we're all becoming legal experts, that the National Prosecuting Agency is, you know, suffering from, you know, 10 years of rout. And what's more is that white-collar crime is not the bread and butter of the National Prosecuting Agency. rape and murder are actually front and center, and there's plenty of that to deal with. And so actually the ability of the National Prosecuting Agency to deal with white collar crime is the experience is lacking, and the ability is not there. Yeah. So one of our suggestions here is, what could industry do to help capacitate the NPA? Perhaps producing dossiers, because the asset managers study these companies, they study the financial statements, and very often, there's certain asset managers are for example, professionally educated to find fraud in financial statements. That's what they do, and it would just be amazing if that resource could be utilized by the National Prosecuting Agency. Yeah. Of course, if it's the other way to take a swipe at white collar criminals is in a civil process, and that's generally quite expensive, but it's a slow process as well. And actually, the issue there that we uncovered is that the asset owners, because they're the ones who actually own the assets, they're the ones who need to be doing the prosecuting in a civil case. The asset managers don't have that mandate. Yep. And that's quite tough, because you now have to rally a group of asset owners to come forward and try to conduct a civil case. The best example of this is actually the Steinhoff case, where there is a civil case running out of the Dutch judiciary, which is much tighter on these issues and it has much more case law, so they can deal with it more effectively. And there, actually, the Dutch are acting on behalf of many of the South African asset owners to, as facilitated by the asset managers, to try and reclaim, lost money out of the Steinhoff debacle. So that is a good example of a civil case, but we need both. We actually need white collar criminals to be brought to book. We need that message to be sent into the corporate space. Is look, behaving like this is actually going to get you into trouble.
Alrighty, thanks. I've got a couple of questions. I want to just shoot them out before our time runs out in 3 minutes. Sorry about this. Shoneen Proctor says, do you have a target wage gap, target ratio between top and bottom? Zwelakhe?
Yeah, it's very difficult to establish that, because there are nuances, like in a certain industry, the skills might be lower down the value chain, and the skills at the top might be quite critical. I'll probably say anything more than 20 times is quite excessive, and that's a personal judgment.
Okay.
Yeah.
Libby Dreyer says, asks, just to talk about fossil fuels for a moment, and are asset managers making decisions on the structure of the existing economy and not taking sufficiently the transformation of fossil fuel into account? Do you think you're underplaying the issue of fossil fuel transformation? Malcolm,
maybe I can quickly provide a response. We do address fossil fuels in our report as well, because it was a topic that came out frequently with the managers. I mean, that in and of itself is a good finding, because it wasn't there really in the past. 10 years ago, it wasn't there.
Okay.
To any great extent. But so it is happening. And in South Africa, it's a particularly important issue. Sasol is a Climate 100 company. In other words, one of the top 100 fossil fuel emitting companies in the world. And so there's quite a lot of pressure around it by both its local and global shareholders around fossil fuel. And, that's been brought to bear. And the other thing is that all South African corporates are influenced by Eskom. In fact, all of us on this call are influenced by Eskom as well. But and that is a major coal, fossil fuel electricity generation. And so, what we do with Eskom and COP26, hopefully gives us some hope there, is how we treat that, over the next 30 years in a just transition process is critical as well to resolving this.
Alrighty. Zwelakhe, Malcolm, thank you so much. That's been a fascinating discussion. Thanks a million. Sorry for the couple of people we didn't get to your questions. I beg your pardon. We will give them to the panelists and ask them to respond to you. But really, it's been extraordinary. If any last words, Zwelakhe, Malcolm, how do you think engagement can be improved? Very quickly.
Yeah, from my perspective, I think as the report points out, I mean, more collaboration is needed. I think the whole thing about hiding behind acting in concert rule, I think that is something that perhaps needs to be dealt with by the fund management industry. Yep. But also the focus needs to also go into other areas other than remuneration and governance. We need to go into diversity issues, things like safety, environmental issues like fossil fuels. Yeah, I mean, I certainly think that those would be significant improvements in the industry.
Cool. Malcolm?
Yeah, just quickly, the thing that strikes me is that this is a fundamental part of activating real investment or investment into the real economy in South Africa. Corporates are sitting on cash, and if we could improve the environment around corporate governance and engagement from asset owners via the fiduciary duty all the way through to the corporates, we could probably actually get a better flywheel going for our country in terms of real investment in South Africa. That's what we need. So we're hoping that our report actually gets out there and that the penny starts to drop. You're kind of fighting yourself. The corporates are fighting themselves because, the more they try to duck and dive, potentially, the more they're actually not contributing towards growing our own country. And making it a sustainable place for us all to live in. So I think that's a message I'd leave you with.
Oh, well, super. Thank you. Thanks a million, Malcolm and Zwelakhe. I also have a suggestion on this point, and that is, by all means, leak the contents of your discussions to some very helpful journalists. That's always an option, and you can. My phone number's right here if you need it. All right,
thank you, Tim. Much appreciated.
Thank you, Tim. Thanks, everyone.
Thanks, people. Thanks,
Malcolm.
Thanks, Zwelakhe. Take care.